Well, I think it's actually a combination of all of those and probably quite a few others. And if you took 10 investors and asked them why they're investing in gold, you'll get 20 different reasons. But there are a few very good reasons. I personally don't buy into the inflation argument. But what does hold this entire argument together is an environment of negative real interest rates, or very low, ultra low interest rates. If you have a look at all of the investment markets that have been booming, China, India, Europe, and the United States, what's the one thing that holds all those markets together? It's low interest rates. And that is the glue that actually ties this entire story together. The inflation hypothesis is ultimately an argument about interest rates being too low for too long. That's what it's about. The interest rates being where they are, it's a function of fear as well. Fear about, well, does Ben Bernanke pull the trigger and drive the US into a recession or even a depression? So there are fear elements to this as well, and overlay this with just general uncertainty about what's happening in the Middle East, and you've got a very, very compelling case for gold and for silver and for the other metals as well.
Well, it's interesting, gold hitting new all-time highs, and we keep on watching that gold price, $1,476 an ounce. But then again, you know, if you look at the inflation-adjusted figure, it's closer to $2,300 an ounce, the all-time high. What numbers should we be looking at when you look at the gold price?
Well, I'm a bit of a skeptic about whether one can actually look at the long-term, 100-year gold price, the purchasing power. And there's a great book by Jastrom, which is updated by the World Gold Council recently, looking at this. But you have to countenance that there's probably some kind of indicative real gold price out there that should prevail, and we're not. But bear in mind, we're not a million miles away from that. You have a look at the graph of real gold prices over the last few years. It's increased radically, and we're still some way off the peak, but the peak was exceptional. So I would argue that we're probably not, a million miles from what is the real price peak, but the market is still sending a signal, and if the policymakers don't get their act together, then we could see gold prices going even higher than this. I have a fundamental belief in the power of these structures to actually eventually grasp the monetary and fiscal nettle. But maybe I'm wrong, and the more I look at what's happening out there, and the more that we do this at GFMS, and the more we speak to the investor community out in the markets of the United States through to Japan, they're saying to us, hang on, we don't trust this, we don't believe this, and this is why you're seeing gold moving up.
I mean, the bulls will tell you that things are looking good. We're seeing a recovery. Yes, the US housing market is still looking a bit shaky. The European Union seems to have its debts issues under control, at least for now. We've seen an interest rate hike there. So Jean-Claude Trichet sending a message out that they are still being prudent, even though 25 basis points won't have a material impact on either growth or inflation. In terms of quantitative easing 3, do you think it is going to be a reality? You're talking about taking the pain or carrying on printing?
Well, if you'd asked me the question 6 months ago, I would have said definitely not. Looking at what's happening now, I'd say probably. And one thing I tell you should read, and your viewers should have a look at, is a paper written by John Whitaker. He used to teach with him at Cape Town University. He's now at Lancaster University. He's deconstructed the European monetary scenario. Read this paper. It's shocking news, because when you actually realize where the liabilities lie and how they've built up in the European monetary system, this idea that we're over the sovereign debt crisis, that's a chimera. This is serious stuff. And you start to look at that. I wrote to all of my colleagues at GFMS, I said, read this paper and go long gold.
It's quite fascinating, because you've got the European Union purchasing bonds, so in a sense quantitative easing in a sense, and then you've also got them tightening, which is interesting because it's a counteractive move at this point as well. The ETF market has been fascinating me for quite some time. One of the reasons that we have seen a lot of flows into ETFs is because of all this excess liquidity looking to find a home. Once that is unwound, can we expect the likes of silver, which we know is sitting at fresh 31-year highs, I mean at $42 an ounce or so, and gold and all those investment metals to come under pressure?
I think they will. Interestingly, a lot of people think that I'm a bear on gold. I mean, if this interview doesn't put that to rights, I don't know what will. But I always sound a cautionary note here. And the cautionary note is an interest rate one. Sooner or later, interest rates have to go up. And it may not be helicopter Ben cranking up the low end of the yield curve. It may be the bond market saying, guys, we're not willing to fund it. And as soon as you see positive real yield, then things like the ETF holdings start to come under pressure, for sure.
Essentially, when the US does start hiking rates, you'd wait for that level. Gold will only really respond negatively once we go into real interest rates and move away from that negative scenario. Is that
it's all about credibility. I spent my academic career looking at central bank credibility. Central banks have lost their credibility. There's only one way they re-establish credibility: with material, positive, real interest rates. Now, looking at where we are today, I don't think it's going to be 2011. Could we wait to 2012 or 2013? If we wait that long, trust me, gold's going to go a lot higher.
Also quite fascinating, central banks forever and a day have gotten the gold market wrong. And now we hear the BOE, the Bank of England, saying that it's not going to be selling out of gold. Shouldn't we be doing the opposite of what the central banks are doing, given the fact that they've gotten it wrong so often?
Well, you know, I like your contrarian view on this. I always, you know, do the opposite of what central banks do. Is not a bad premise. They got it wrong in the 1990s. I mean, they sold increasingly into price weakness, which never made any sense to me. And they're now looking at buying. Maybe it is an indicator that we're at the top of the market.